Welcome to this video on deferred tax. My name is Megan Gajewski and I'm here to answer all of your accounting related questions. So in this video, I want to work through an example where we are recognizing deferred tax on a particular asset like PPE, but then we go and sell it. And what I'd like to do in this video is to highlight to you how deferred tax works, how we calculate that deferred tax, and how that lines up with what our expectation is of what the tax expense is meant to be. So if you need some background on deferred tax, I do encourage you to check out my playlist for third year accounting, where I cover a whole lot of deferred tax. Okay, and once you've done that, I assume you're all caught up to date, and let's get into this example. So in this example, we have, let's imagine we have an item of PPE. Okay, so we have an item of PPE that we're dealing with. The original cost, okay, of this asset was 1,500, and it now has a carrying amount of, a carrying amount of 900. Currently, the tax base of this asset is 750, and we have now decided that we're going to sell this asset, and so we are going to sell the asset for 1,600. And the question is, how is this sale going to be reflected in our financial statements? Okay, so the first thing we need to look at is what is the current deferred tax balance relating to this asset. And the reason why we want to understand that, because we need to understand what currently, as it relates to tax relating to this asset, is sitting in our statement of financial position. Okay, so if we go and calculate what the current deferred tax balance is, we're going to go through our normal calculation, which is comparing the carrying amount to the tax base. We will then determine a temporary difference. We will apply the tax rate, and then we will calculate our deferred tax liability or asset. Okay, so when we're calculating deferred tax, remember that deferred tax is calculated on all the assets and the liabilities that are currently sitting on the statement of financial position. So the question here is, at what amount is this asset currently sitting on the statement of financial position before we even make the sale? Okay, we know that the carrying amount is 900 because it's been given to us. So we can, for this item of PPE, we can insert a carrying amount of 900. Now, the question has told us that we have a tax base of 750. So with regards to the tax base, what do we know? We know that this represents the future deductions that we are still able to claim with regards to this asset. Okay, now once we subtract the one from the other, we get that we have a temporary difference, and this temporary difference is a taxable temporary difference. Now, why is it a taxable temporary difference? Okay, well, think about what the implication of the carrying amount is over here. Okay, this carrying amount that we've recognized here of 900 is what is going to hit our income statement in the future, right, in the form of some form of expense. Okay, so we're going to recognize total depreciation of 900. That means that in the future, my accounting profit is going to be reduced by 900. But from a tax perspective, we only have future allowances of 750. So that means that my tax profit will only be reduced by 750. Okay, so that means that in the future, my tax profit is therefore higher than my accounting profit, because I have less deductions to utilize in the future, and therefore I expect to pay more tax. And so we can say that the temporary difference is taxable. Okay, and this asset is being it's a PPE asset, so PPE assets are recovered through use, and the applicable tax rate we can assume is the normal tax rate, which is 28%. So having done all of that, we can calculate that we have recognized a deferred tax liability of 42 in the statement of financial position. Okay, so that is what's currently sitting in the statement of financial position. Now let's take a step back and think about the impact of selling the asset in the current year. Okay, so let's deal with the sale of the asset. what's going to happen when we sell this item of PPE? Well, the first thing that's going to happen is that we're going to recognize a profit on sale, okay, based on the PPE. And how would we calculate that profit on sale? Well, the profit on sale, okay, the profit on sale, the way we're going to calculate that is we're going to take whatever our proceeds are, and from that we're going to subtract our carrying amount. So we're going to be selling this asset for 1,600 and the carrying amount of the asset is 900. So that means that we have a profit of sale on sale of 700. So that's the profit that is going to be hitting our income statement. Now, if we have that profit, okay, I want you to take a step back now for a minute, and I'm going to change the color of my pen again. I'm going to change it green, okay, because I want to highlight something, which is what is our expectation? Okay. So if we see, okay, this profit of 700, what is our expectation with regards to the profit of 700? Well, okay, let's think about it. We understand that the carrying amount, okay, is 900. The original cost of the asset was 1,500. So our expectation in terms of the tax related to this asset, or to the sale at least, is that there's going to be an element of CGT, and we have an expectation that there is some form of a recoupment that needs to happen. Okay, so how do we calculate the CGT? The CGT is going to be the difference between the proceeds and the base cost, which is the original cost of 1,500, and we're going to multiply that by the effective tax rate, which is 22.4%, and that's going to give us tax of 22.4. Okay, so that's current tax, right? That's our expectation for current tax. And then with regards to the recoupment, what is our expectation? Well, we've recognized a profit of 700, okay? 100 of that profit is subject to CGT. So our expectation is that the remaining 600 of that profit is going to be subjected to normal tax. Okay, because it would be a recoupment, of course, and that's going to be 168. So in terms of what our total expectation is for tax, right, we expect that we are only going to have to pay tax of 190.40. Now, whether that actually is what ends up happening remains to be seen, but I want you to understand this. We've recognized the profit now, 700, and our expectation is that that profit will be taxed in the form where 100 of the profit is subject to CGT and the remaining 600 is subject to normal income tax. Okay, now let's look at what is the actual current tax that we're going to pay and what is the actual impact of the deferred tax. Okay, so let me change my pen, and I'm going to change my pen back to blue, and I'm changing it back to blue because when we're dealing with blue, that's what's actually going on here, right? What I've done in green is an expectation. Okay, so let's think about what the actual current tax is. So what is my actual current tax? Okay. Now, the first thing I know is that my CGT, when I sell my asset, at least there is going to be a CGT component because we've sold the asset for an amount that's greater than the original cost. So the portion above the original cost is, of course, what is going to attract capital gains tax. So my actual current tax that I end up paying would be my capital gains tax. And the way I calculate the capital gains tax, it's the 1,600 minus the cost of 1,500. We multiply that by 22.4, and that gives us 22.4 as the current tax, okay? And that is actually in line with what we expected. So there's nothing abnormal there. Okay, now let's think about the recoupment and what exactly is going on there. So with regards to our recoupment, okay, When we sell our asset, okay, think about it like this. SARS has given us allowances, or the tax authority has given us allowances, right? All the way down to 750. So if we originally had the asset at a price at an original cost of 1,050, that means in total, okay, we actually claimed allowances of 750 thus far. So those are the tax allowances that we've already been granted. Now, when we do our recoupment calculation, okay, how do we do the recoupment calculation? We actually look at what we recouped from the tax base of the asset, because if we've taken 750 in allowances, that is the difference between the 1,500 and the 700 tax base. If that's all the allowances that we've taken, then those are the allowances that are going to be recouped. Okay, so the full 750 allowances will be recouped, and that is going to be taxed at 28%, and that gives us a current tax expense of 210. Okay, so this 210, this is the actual current tax that we pay with regards to the recoupment, but it differs to what our expectation is. And why does it differ, right? Because in our expectation was developed upon what the profit is that we recognize, right? And the profit is 700. But what actually happens is that the allowances we are granted actually reduce the tax base of the asset down to 750, and it's that the difference between the 1,500 and the 750 that ends up being recouped. But when we calculate the profit from an accounting perspective, it's an accounting profit, so the profit is the difference between the proceeds and the carrying amount. Okay, now so far, if I add up these two, then I have that my current tax comes to 232.40. So this is my total current tax. Okay. Now, is my current tax the same as my tax expense? No, it is not. Okay, because we know that our tax expense is equal to our current tax plus our deferred tax. Okay, so we already know that our current tax is 232.40. Okay, so that's the actual current tax that we end up paying. But what about our deferred tax? What do we have in terms of deferred tax? Well, let's go back up to that deferred tax calculation. Over here, we've calculated deferred tax, right, on the carrying amount of PPE, which is 900. But once we sell this asset, we no longer have the asset reflected on the statement of the financial position. That means that 42, which is currently sitting there, we would need to de-recognize that liability. So what journal entry would we process? We would end up debiting the liability and crediting deferred tax in profit or loss. So that means that my tax expense is actually going to be reduced by the 42, because there's a deferred tax that I'm recognizing, and it's actually an income which is reducing my tax expense. And that, if I work out the math over there, it brings my total tax expense to 190.40. Okay, so that is what my total tax expense is. And why does this number seem so familiar to us? Sorry, I can't do that in green because I've written in green, it's too red. Okay, so why does this number seem so familiar to us? Because this is the number that we expected our tax expense to be. Okay, and now we've actually been able to get back to that expectation. So let's take a step back and think about the process that we underwent and why we did those things. First and foremost, we calculated the deferred tax based on the carrying amount of the asset. And that's really important because we can only provide for deferred tax up until the carrying amount of the assets and the liabilities that are recorded in the, or that are recognized in the statement of financial position. Thereafter, we dealt with the sale, okay? And in terms of dealing with the sale, we recognize the fact that there's going to be a profit on sale, but that profit on sale is going to be subject to tax, okay? What tax is it subject to? It's subject to our current tax. And we worked out what our current tax is, because our current tax forms part of our tax expense. But we know that our current tax is not the full story when it comes to tax expense, because we also need to account for deferred tax. And where is that deferred tax coming from? The deferred tax is coming from the fact that we've recognized a liability in the statement of financial position relating to deferred tax on this PPE. But what has not happened is, but what has now happened is that we've sold that item of PPE. So once we sell the item of PPE, we can no longer have that liability sitting on the statement of financial position, because we've already, in recognizing deferred tax, we're providing we're acknowledging the fact that we have to pay more tax in the future. And now, because we've sold the asset, we've actually realized the profit, we've realized and paid the tax that we needed to, and we can thus remove deferred tax. So if we combine our current tax and our deferred tax, we get our total tax expense. And this tax expense is exactly in line with what our expectation is. So that is what is so beautiful about deferred tax. I hope that this example made sense to you. If you have any questions on this, pop it right down there in the comments and I will get back to you. I look forward to engaging with you in the comments, in the chat. So send me any message if there's anything that you're struggling with, and I'll make sure to film a video. See you in the next one. Bye-bye.